Welcome back to Power the Dollar YouTube channel. Today, we're discussing credit spreads. First up, how they work. Number two, can they be used to predict a recession? And finally, is it predicting one right now? So first things first, let's cover what a credit spread is. Here's a visual to help you understand credit spreads. The dark gray line here represents U.S. Treasuries, which is considered the safest bond that an investor can buy. And this light blue line here, this represents AA rated investment grade bonds. This reflects companies that have absolutely impeccable financial standing. And finally, up here at the top, this dark blue line represents CC rated investment bonds, also known as junk bonds. Sure, you've heard that before. And this represents companies that don't have the best financial standing and they have a higher probability or likelihood of going bankrupt compared to these AA rated bonds. So let's say for the sake of this chart, U.S. Treasuries yielding a 4% return. These AA bonds are yielding a 5%, and these junk bonds are yielding a 7% return. So as the economy slows down, even safe companies right here, they're going to start to perform poorly and become a bit riskier. Now, they're not as risky as these junk bonds, but they're certainly going to be riskier, okay? And let's focus on this space right here. This space right here is called the spread. And as these AA companies become riskier, investors are going to demand a higher yield as risk increases. So this line is actually going to move up. And what does that mean? That means this space is increasing or widening. And this is what the widening of the credit spread is and why it's seen as bad for the economy. So now that we know how a credit spread works, let's look at this chart again. And we're using this chart because it's currently going around the internet and people are saying it's predicting a recession. But is it really? Let's take a closer look. There's a couple parts of this chart to understand. There's a blue line, red line, and these gray shaded areas. First up, this blue line, this represents spikes in stock market volatility. This red line, this represents credit spreads, which we just discussed. And these gray lines here, these gray shaded areas, these represent recessions. And you can see when a recession hits, both these metrics, stock market volatility and the credit spread, they spike. But what else do you see in this chart? In 5 or 6 different areas, you can see that both of these data points, they spike and there's no recession. So what does that lead me to believe? That this index right here is not a reliable indicator of a recession on its own. But if you pair it with other economic data points such as unemployment or the SOM rule, which is currently very popular, or a couple other economic data points, you could start to gather clues on whether you think a recession is coming, and you can start to make a guess more accurately. But now, let's see if this is presently predicting a recession. So now I've zoomed into this 5-year time frame here. It's going to give us a more accurate look at the data and what's actually going on. So you can see the spike in volatility here. Now, what caused that? A week or two ago, there was something called the yen carry trade. This started unwinding and it caused all kinds of pandemonium in the stock market last week. So now that we understand what caused this spike, let's look at what the clickbait people want you to see. Let's zoom back out. This is what they want you to see. Anytime there's a recession, both these lines spike up. And what's happening over here? You can see both these lines are pointing in a very bad direction. So if you take the clickbait people at their word here, you would start to think, whoa, a recession, it must be on the horizon. These are starting to trend upwards. But here's what they don't want you to see. When you zoom in and get more accurate data, you see this spike here. What's happened since? All this volatility has cooled off. It's back down almost to where it was prior to the whole carry trade unwinding. Same goes for the credit spread. So back to the point of this zoom in right here. Is this pricing in a recession? Is this predicting a recession? This alone is not pointing towards a recession, if you ask me. And if you're going to use one piece of economic data to price in a recession or predict a recession, it's not wise. They're not always accurate. It's very important to use other metrics such as unemployment, the SOM rule, inflation, you name it. Now, could this start to spike again? Let's zoom back in. Absolutely. And now, could we be on the doorstep of a recession? Absolutely. Especially with many big bank CEOs starting to show signs of worry. Warren Buffett said a couple years back he has never sold a share of Apple. Now, that doesn't mean he was never going to sell a share of Apple, but he was so confident in Apple going forward for the longest time. And recently, what did he do? He sold more than half his stake in Apple. And JP Morgan CEO Jamie Dimon is saying that there's an ever-increasing chance of a recession. But as of now, this chart itself is not pointing towards a recession. I hope this video has helped you understand what a credit spread is and how it can be used to predict what's to come with the economy. I know at first glimpse it can look and sound a little bit confusing, but as you now know, it's actually pretty simple. If you enjoyed this video, please give it a like to help support the channel. Also, consider subscribing so you can be notified of all future videos just like this. And if you have any questions, please drop a comment below. I'd be glad to help you out. As always, thank you so much for tuning in to Power of the Dollar YouTube channel, and I'll see you next time.